Okay, so let's just proceed from where we ended. So before we proceed, I welcome you all from your weekend, and I hope you had a great weekend. Yeah, I hope it was great. Okay, so we have a subtopic in commerce, which is balance of trade, balance of trade. Okay, so let's continue like we do by first of all defining what the term balance of trade is. So what do you understand by the term balance of trade? So balance of trade is the difference between visible export and visible import. We have said that balance of trade is the difference between visible export and visible import. So we can take note of this. We have said that balance of trade is um, the difference between visible, okay, so this is visible imports or visible exports and visible imports. Okay, so this is what we call balance of trade. The difference between visible imports and visible exports is what we get to call balance of trade. So this is the balance of trade, the difference between visible export and the visible import. So if visible export exceeds visible import, a country is said to have a favorable balance of trade. Oh, sorry, a favorable balance of payment. So of this term, favorable balance of trade. So we have said that favorable balance of trade is when the export exceeds the visible import. So this is when the export exceeds the visible import. So we can write this. So we have said that favorable balance of trade is when the visible export is when the visible visible exports exceeds visible import. Okay, so this is import. So favorable balance of trade is when the visible export exceeds the visible import. So a favorable balance of trade, it's sometimes known as a trade surplus. So trade surplus and favorable balance of trade, they are one and the same. So you should also know that if visible imports exceeds visible exports, a country is said to have unfavorable balance of trade or trade deficit. Okay, so I've said that if visible imports, so if our visible imports, so I'm just going to write it in this way so that you remember. So first of all, on balance of trade, we said that when exports exceeds, so we're going to use greater, exceeds imports. This is equal to trade surplus or favorable balance of trade or trade surplus. Okay, so this is favorable balance of trade. So I've just abbreviated it, but don't write it. It's like this. So I've written this in case you forget. So I've said that favorable balance of trade is when export, or let's just say export, when exports are greater than the import, this is equal to favorable balance of trade or trade surplus. So we also have another situation where the imports are greater than the exports. So this will result into unfavorable balance of trade, unfavorable balance of trade. So this will have unfavorable or trade deficit. So I'm going to write it, or trade, this T stands for trade deficit, like this. Okay, so this is what we mean by favorable balance of trade and unfavorable balance of trade. On favorable balance of trade, we say that exports are greater than the imports, and on unfavorable balance of trade or trade deficit, we say that here imports are greater than the export. So first of all, we said that visible imports. So what do you understand by visible imports? What are visible imports? So we have the term visible imports. Okay, so visible imports are, visible exports, visible visible imports are goods that are seen and touched. Goods that are seen and touched, that's what we call visible imports. So visible imports are goods that are seen and touched, which a country buys from other countries, such as cars, cell phone, computer, drugs, and clothes. So this we have said that the visible imports are goods goods that are seen and touched. That or which a country buys from another country. Okay, so this is what you call visible imports. Goods that are seen and touched, which a country buys from another country, is what we get to call visible imports. And this includes cars, vehicles, computers, drugs, and clothes. Okay. We also said another term, which is visible export. So here we have visible exports. So visible. Okay, so visible export, remember here we defined visible imports, and we said that visible imports are goods that are seen and touched, which a country buys from another country. So visible exports are goods that are seen and touched, which a country sell. So you see the difference between visible imports. Imports are bought, whilst the exports are sold. Okay, so visible exports are goods that are seen and touched, which a country sells to other countries. So we can write this. So we have said that visible exports are goods that are seen and touched, which a country sells to another country, and this includes copper, sugar, cement, etc. Okay, so a country's balance of trade is said to be favorable when so this is just a summary. So a country balance of trade is said to be favorable when there is trade surplus. So trade surplus is the same as favorable balance of trade, and we said that trade surplus, this is when the visible exports exceeds the visible imports. We even summarize it like this. Okay, so I said that a country balance of trade is said to be favorable when there is a trade surplus in favor of the country. Okay, this situation is visible when the visible, okay, so this situation is visible when the visible exports of a country exceeds the visible imports, like we wrote here. Okay, exports is greater than the imports. So I'm going to give an example on this one. So let's say Zambia's visible exports amounted to be maybe we have the let's say like this. If Zambia visible exports cost to 200 million kwacha. Okay, if Zambia visible exports costs 200 million kwacha, and if visible imports cost, let's say the visible imports maybe cost 80 million kwacha in the same year, it will result into favorable balance of trade. So this will result into favorable balance of trade because the exports are high compared to the amount spent on the imports. The amount of money spent on the export is high compared to the amount of money spent on the imports. Okay, so this we can find trade surplus as we just subtract the exports, the amount of export minus the amount spent on the imports. So we're going to have 200. So let me just exchange the marker. So we are going to have 200 minus, so this is 200 million. Let me write it clearly. Okay, 200 million minus 80 million, and this will give you 120 million. Okay, so this the surplus that you get, this is what we call trade surplus. So this is a positive figure because this is a greater number, hence the greater number is positive, so we're going to get the sign from the bigger number, which is 200 million. So the positive figure of 120, which is this one, will be regarded as trade surplus. So this is trade surplus. So we can name this as trade surplus. Okay, so this is trade surplus. In other words, we can say that Zambia has gained. It has gained because we have the trade surplus, and this means that there is a favorable balance of trade. Okay, on the other hand, we can say, okay, so on the other hand, we can say now a balance of trade is said to be unfavorable or imbalanced when the visible imports of a country exceeds its exports. So let's just see, look at one of examples on the unfavorable balance of trade or imbalanced trade. So let's again, if Zambia exports about 80 exports good worth 8 million, and sorry, so this we can, let's say maybe Zambia imports goods worth 8 million and exports goods worth 200 million kwacha. Okay, so this is the amount of money. So the imports cost 800 million and the exports cost 200 million. Okay, and so let's see if Zambia will have trade surplus or favorable balance of trade. So we do as usual, exports minus imports. So this exports, so this is exports, and this is the amount of money spent on the import. So we're going to have 200 minus 800. So this is million, and this will give us 600 million. So 600 million. So this will be in negative form because here the bigger number has a negative sign. So since this is money, a negative sign is not important, it's ignored. Okay, so the negative figure, which is this 600, we have said that this will be in negative form, will be regarded as deficit. So this is called deficit. So we talked about deficit on the unfavorable balance of trade. So this will be deficit. So here we can say that Zambia has lost out. Remember, here we said that Zambia has gained. Here we can say that Zambia has lost out because there is no trade surplus or favorable balance of trade. So this is the unfavorable balance of trade. Okay, so according to the calculation here, you can tell that the balance of trade is calculating using the formula. So the balance of trade is calculated using the formula. Balance of trade. So we have balance of trade. Balance of trade is equals to visible export minus visible import. Okay, so this is the visible export and this is the visible import. So this is the formula you can use to calculate the balance of trade. Okay, so balance of trade is equals to visible imports minus visible export. So this is all about balance of trade. So let's proceed to balance of payment. So we have balance of payment. Balance of payment. Okay, so balance of payment. Balance of payment is the difference. Hear me clearly. Don't confuse balance of payment and balance of trade. So balance of payment is the difference between visible export plus invisible export and visible imports plus invisible export. So let's write this so that we clearly understand. I'm going to explain a bit so that I give you an idea of what we are talking about. So I've said that balance of trade is the difference between visible exports plus invisible export and visible imports plus invisible imports. Okay, so this is what we call balance of payment, the difference between visible export plus invisible export and visible imports plus invisible import. So you can, in short term, you can define balance of trade as the difference between the total sum, the difference between the total sum. So I'm going also going to write this, so in case you forget this. So you can, in simple terms, you can define balance of trade as the difference between the total sum of exports and the total sum of the total sum of imports. Okay, so in short term, this is what you call balance of trade. So rather than you saying that is the difference between visible export plus invisible export and visible imports plus invisible export, you can just define it as the total sum of exports and or the difference between. So there is difference between total sum of exports and total sum of imports. Okay, so this is what you call balance of trade. Okay, in a formula we can write it as like this: balance of trade. So B, balance of trade. Oh, sorry, balance of payment. So balance of payment is equals to visible exports plus invisible export. So this is invisible export. Okay, so let's just write it like this. Okay, so balance of payment is equals to visible export plus invisible export. So this minus visible imports plus invisible imports. Okay, in case you just forget, so you can remember using this formula: visible export plus invisible export minus visible imports minus plus visible or invisible imports. Okay, so this is what we call balance of payment. Okay, so if visible export plus invisible export, so hear me clearly here. If visible imports, okay, plus invisible export exceeds visible visible imports plus invisible imports, a country is said to have a favorable balance of payment of trade. So if the total sum of the exports exceeds the total sum of imports, a country is said to have a favorable balance of payment. So you can write favorable balance of payment as so a favorable. Okay. Favorable balance of payment. So favorable balance of payment is when the visible export, this is when the visible export plus invisible exports exceeds visible imports plus invisible imports. So in short term, we can say that favorable balance of trade is when the total, okay, the total this is when the total sum of imports, oh sorry, the total sum of exports exceeds the total sum of imports. Okay, so this we can also write it as favorable balance of payment is when, in a formula it can be written like this. So okay, so favorable balance of payment is when the total export, so this is total export, exceeds, is greater than the total imports. So this is what we call favorable balance of trade, favorable balance of payment. When the total exports exceeds the total import is what we get to call favorable balance of payment. So in the other hand, first of all, if there is a favorable balance of trade, let's say this situation has occurred where the total export here is exceeding the total import. Here we will say that a country has a surplus. So here we have trade surplus. Okay, so this is trade surplus because the total exports is greater than the total imports. Okay, so in the other hand, or on the other hand, we can say that if visible imports, okay, if visible imports plus invisible exports exceeds visible exports plus invisible export, a country is said to have an favorable balance of payment. So I mean this. So unfavorable balance of payment, so we're just going to have it here. So favorable balance, okay, unfavorable balance of payment is, okay, so unfavorable balance of payment is when the total imports exceeds the total exports. So when a country has more total number of imports compared to the total number of exports, here we say that we're going to have unfavorable balance of payment, unfavorable balance of payment. And on this situation, we're going to have a trade deficit. Trade deficit, of talked about this. So we're going to have trade deficit. Okay, so let's just create space for more important notes. Okay, so under balance of payment, invisible exports are services. So under hear me clearly, under balance of payment, invisible exports are services sold to other country like insurance, banking, transport, manpower, etc. and tourism. Okay, while invisible imports are services bought from other countries such as tourism, banking, manpower, and insurance. So invisible imports are services that are bought, okay, and whilst invisible exports are services that are sold to other countries. So we know what export and import is. So let's now talk about the favorable balance of payment, okay, and see some one or two examples. So we said that favorable balance of payment. Okay, so let's just write the title. The title is very important so that we don't forget what we are talking about. So in this balance of payment, we're just going to add favorable. Okay, so this, okay, or we can just write favorable balance of trade, of payment, sorry. Okay, favorable balance of payment. So favorable balance of payment of a country, or we can say that the balance of payment of a country is said to be favorable when the total amount of money a country earns from the exports of goods and services exceeds the total amount of the money a country spends on import. Okay, so I even gave that memory note where I said that the favorable balance of trade is said to have this is when the amount of money spent on the exports, the total amount of money spent on the exports is the total money earned through the exports is greater than the total money and spent on imports. Okay, so the balance of payment is said to be favorable when the total amount of money a country earns from exports exceeds the total amount of the money a country spends on imports. Okay, so this is what we call balance of trade. Okay, when the country ends or when the amount of money a country earns from export of goods and services exceeds the total amount of money spent on imports here, this is what you get to call favorable balance of payment. Okay, so let's look on one or two examples. So of this example which says if Zambia exports, okay, if Zambia exports good worth 5 million kwacha and services with so these are goods and services with 400 million. So these are goods, so I'm just going to add the G which stand for goods. So if Zambia exports goods, worth 500 million and services worth 400 million, but imports goods, so these are the imports that I'm going to write, but imports goods worth 300 million kwacha and services worth 150 million kwacha in a given year. Okay, so state whether the balance of payment will be favorable or unfavorable. So that's the question. State whether the balance of payment will be unfavorable or favorable. So we have the exports here on top. So these are the exports. So we have Zambia, which exported goods worth 500 million and services worth 400 million, but the imports of goods costed 300 million and 150 was the amount of money spent on the services, on the important services. Okay, so we have been told to state whether this country called Zambia will have a favorable balance of payment or unfavorable balance of payment. So we know that favorable balance of payment, FBP, so this stands for favorable balance of payment, is given by the formula total exports minus total imports. Okay, so this is the formula, total exports minus total imports. So this I stand for import and this E stand for exports. So let's now begin our mathematics. Okay, so we have the exports, the exports which are 500 million and this 400 million. This is the money which was spent on the total total exports. So we are going to have total exports. So total means the sum, so we need to come up with the sum of this. We need to find the summation. So we're going to have 500, let me just extend the marker. So we're going to have 500 million, 500 million plus 400 million, because these are services. Okay, minus the total imports, which was these are imports here, 300 mil plus 150 mil. Okay, So 500 plus 400 million, here you are going to have 900 million kwacha, minus 300 million plus 150 million, you're going to have 450 million. Then you find the surplus. 900 million minus 450 million, it will give you 450. So this is the surplus. This is the surplus. So the figure or the amount 450 will be regarded as surplus end. So this 450 will be regarded as surplus ends. So that is to say Zambia has gained, and so the balance of payment is favorable. So here we have favorable balance of payment. Favorable balance of payment. Okay. And we can say that Zambia has gained. So on the other hand, the balance of payment may be said to be unfavorable. Okay, so the balance of payment may also be said to be unfavorable. Okay, so for example, if Zambia imports goods worth 600, so we have the goods. So these are the exports. So goods worth 450, so these are the export. 450, and services with 120, and imports goods worth 600. Okay, so we have goods exported with 450 and services which are exported with 120. We also have goods imported with 600. So these are goods imported. We have 600 and so this is million. Okay, and we have services exported. Oh, sorry. Services imported with 250. With 250, and we have been told to find the surplus. So this is million. Okay. So we know that balance of payment is given by the formula total imports minus total export minus total imports. Okay. So we have the export which 450 and 120. So we're going to come up with the summation of this. So 450 plus 120, it will give you 570. So this will give you 570 minus total input, which is 600 plus 250, which will give you 850. So 570 minus 850, this will give you a negative 280 million. Okay, so since this is money, we can consider it as 280 million kwacha. Okay, so since our surplus is in negative form, so we can say that here there is unbalance of payment. There is unfavorable balance of payment, imbalanced payment. So this figure, which is negative 2, will be regarded as trade deficit. So this is trade deficit. So this is a trade deficit. That is to say Zambia has lost out. So here Zambia has lost out. So the balance of payment is unfavorable. So the balance of payment is unfavorable because we have trade deficit, and we have said that Zambia has lost out. Okay. So in short, the following formula is used to calculate the balance of payment. The following formula is used to calculate the balance of payment. Okay. So we said that balance of payment is equal to total visible or total exports, whether invisible and invisible. So this total export involves invisible and visible exports. So we have total export minus total import. So in this total import, we have the visible and invisible import. So I guess due to time, today we're going to end here. We proceed from where we have ended. I greet you